So moving on to our next presentation, we are going to the tax world of accounting. Our tax services group, as the name suggests, is at the forefront of providing tax planning, compliance, and consulting services to a diverse array of clients, including corporate, individual, nonprofit, and estates and trusts. They play a vital role in helping navigate the intricate landscape of tax laws and IRS regulations, which, as we well know, are not only complex, but they're also continuously evolving. Today, we are fortunate to have two experts join us from our tax services group to shed light on the latest tax updates and significant changes that have occurred. Our first speaker is Michael Weber. He is a partner in this group. Mike is not only a CPA, but an attorney bringing a valuable expertise to his clients for over 10 years. Joining Mike is our second speaker, Rebekah Flanders, a senior manager in the tax group with nearly 2 decades of public accounting experience. Please join me in welcoming our speakers, Mike and Rebekah. Thank you.
Good afternoon, everyone. It's our pleasure to be up here and to kick off the second half of our day. But you know what, we had just a little bit of trouble with this morning and the game show theme, and Mike and I felt a little left out. So we have renamed our presentation to Press Your Luck. If you're not familiar with this show, it's a game of wit, strategy, and high stakes as contestants try to avoid the whammy and try their hand at winning life-changing cash and prizes. So in the case of our discussion today, we're just talking about taxpayers, the everyday taxpayer business owner who just wants to take advantage of every available tax deduction and credit, all while navigating an ever-changing landscape of rules and reporting requirements and trying to avoid the proverbial tax whammy. So on our episode of Press Your Luck today, we want to talk about the Employee Retention Credit and recent developments. We'll cover the Federal Corporate Transparency Act and some new reporting requirements related to that, as well as an annual Pennsylvania reporting requirement that comes into play over the next year or so, as well as a few nuggets related to research and development and research and experimental expenditures, pass-through entity tax elections at the state level, as well as a little bit of potpourri, because what update is complete without some potpourri topics. So with that, I will turn this over to Mike, and he will get us kicked off on employee retention credit.
Okay, well, before I get diving into this interesting topic, just a couple other housekeeping items. John, I can't believe you said that about the IT and all the technology. I didn't hear you knock on the wood here, so hopefully nothing goes wrong during this presentation. The other thing is, this is probably the most challenging position to be in the day, because it's right after lunch and right before the cookies. And I saw them baking them back there, so they'll be out there shortly. But please stay for our entire presentation. And the other thing is that, if you can believe this is only the second time in the last 365 days that I tied a tie. And the other time was last year's CPE day. So if you're wondering how to tie a tie, see me afterwards. I have a nice YouTube clip for you. All right, with respect to the employee retention credit, at this point, you'd have to basically be living under a rock to not know what I'm talking about right now. Because of course, everybody's been getting flyers in the mail. You hear it on the radio. You've got, various individuals really, out there saying, hey, any business really qualifies for this. And just to take a second to just rehash where we're at. Of course, this is a refundable tax credit that came up about as part of the CARES Act and subsequent legislation. And basically, what it says is, in a nutshell, if you were affected by COVID, there's this credit that you can get. It is refundable. You've got these gigantic refunds that businesses are claiming. And we have up here, the metrics, $5,000 a person for 2020 and up to $21,000 for 2021. So that's kind of where we're at. All right, approximately 3.6 million claims have been filed since the ERC came about. I did look this up. You might find this interesting. When Congress put this into the CARES Act and subsequent legislation, they were anticipating that this would cost the U.S. government about $85 billion. And right now, we have roughly $230 billion paid out, and still 849,000 claims that are still pending out there. And there's obviously a gigantic processing time. Of course, that doesn't include all the claims that have still yet to be made. So who knows where we're going to end up with this? We could be, well north of, $300 billion whenever, the government was really thinking that, hey, we're going to be ending up with around 85 billion. That's a unbelievable difference. Okay, so of course, the IRS looks at that and they're onto this. They're saying, hey, there's probably a lot of fraud, a lot of issues relative to these claims, especially the ones that are being made right now. And the IRS does come out every year, believe it or not. There's a dirty dozen tax list. You really don't want to be on this list. And of course, this year, the number one item on that list is the employee retention credit. So, if you're concerned about it, there's a lot of things you really need to think about. But of course, the IRS is also looking at this as well. I did pull down some of the other dirty dozen claims. You might find some of these interesting. Believe it or not, individuals setting up fake charities after natural disasters, that's an issue. Offer and compromise, websites and mills, I'm sure we've all heard those on the radio, seen those on TV. Oh, the IRS will settle your claim for something less than what you actually owe. And here's another one, shady tax preparers. So I did look up the list, and Grossman, Yannick, and Ford and myself, we're not on it. So we're not shady. We're legit. All right. So how do you know if somebody that's contacted you is really part of an ERC conglomeration that's an issue? Well, the IRS is, they've listed a number of red flags. Let me read them to you here. You've got unsolicited calls or letters. I'm sure everybody's received those. The organization you're working with says that it's an easy process. They're taking large fees up front and, of course, contingent fees. And in certain situations, I've never actually encountered this or seen this, where the preparer is actually unwilling to sign the tax return. Basically, they just prepare it and then put your name on it. You sign it, send it in. But they don't want to be a part of it. Okay, that's an issue. And then, of course, leaving out some important key facts relative to the retention credit. And one of those key facts that usually is left out is the fact that receiving this money really generates taxable income for you. That's sort of a bad thing if you're trying to pitch it to somebody, saying, well, you're gonna get X, but then here's our fee, and then you have to pay tax on it. So you're really left with something down below. So they leave that piece out. I did reach out to a number of different colleagues here in Pittsburgh, and I was unable to find anybody that actually has an ERC audit going on right now. I did contact a number of other CPAs in my network and attorneys at law firms here in Pittsburgh. I'm not saying they're not out there, but at this point, I'm not aware of any based upon who I've talked to. And that does kind of coincide with, I think the IRS is really taking a long look at this and really trying to get their ducks in a row. And what Rebecca and I have found is that really looking at probably 2024 before we see an inordinate amount of claims here, or audits. There have been some, criminal cases brought, and I thought this was kind of interesting too. A couple of people have actually went to prison, and that has to be an interesting conversation. So, like, what are you in here for? Well, let me tell you about this ERC credit. It seems like it's a breeding ground maybe for some more fraud that could be occurring. The last thing really also that I find problematic with respect to this and relative to these audits, if you really think about the timeline of how these things can come about, that you can really find yourself in a situation where you're receiving an inquiry or a letter in the mail from the IRS relative to your 941X. That's really where this audit would occur, right? And the IRS is going through that. They're analyzing your situation. And let's just say hypothetically that, down the line they say, well, hey, we're going to deny this claim, and you exhaust all your different processes and you ultimately lose that. Well, guess what? You had to have picked that income up on your on your corporate or partnership S corp tax return and included that income. You might find yourself in a situation where the IRS has denied your claim, and you can't remove that income from your corporate tax return. So if you're really nervous about this type of thing, and you know, you think you have some type of issue and you've got some type of claim out there, you might want to, you know, reconsider your position. And Rebecca's going to talk about a little bit later on, you know, some of the ways that you can sort of get out of it. It's similar to how the PPP loans, there was a grace period if you know, applied and you said, well, hey, you know, based upon what I know now, I really don't think I should have, so we'll be able to give the money back. There are ways to do that. So with that, I'll kick it back to you.
Yeah, so the IRS's response to the uptick in the problematic claims was in mid-September to issue a moratorium on processing any new claims. So the IRS on September 14th announced that it will not be processing any claims received between September 14th of this year through at least the end of the year. And their goal in that is twofold, or a couple different goals in the moratorium is they need to get through this astounding backlog. And the backlog just keeps growing and growing and growing. I think at the beginning of September, the backlog was 600,000 some. Mike just noted that at the beginning of October, it's 849,000. So there's just an unbelievable amount of processing that the IRS does need to do on claims that have been received prior to September 14th. They also want to, of course, focus on some increased scrutiny, some digging into in more depth these refunds claims that have been received. In addition to digging deeper, they expect that there will be more instances where audits will be opened into claims that have been incorrectly or potentially fraudulently filed. So, you know, with that backlog, there's going to be some more investigation, is what the IRS is anticipating. You know, our experience as preparers and advisors has been, you know, it has taken a monumental effort in some cases to get the refund checks issued to clients who, you know, really do deserve these refunds, even to the tune of months and a year and 18 months to try to get these back and to try to work with the IRS to continue the checking in on the progress. So originally the goal was to process claims received within 90 days. That was well in, you know, the actual processing time was well in excess of 90 days. The newly stated goal is 180 days. But, you know, I would say we're skeptical that that 180-day mark is going to be met for these claims and for the processing. Along with the moratorium, the IRS is developing or has developed two programs. There's a settlement program that will be available. There has not been any further detail released on a settlement program. This would be if a taxpayer has received a refund, has already deposited and negotiated that check, but would like to go back to the IRS and kind of self-disclose, you know, hey, we got this in error. And so the settlement program will be designed to help alleviate or eliminate interest and penalties on incorrectly issued refunds. The second program is a withdrawal process that the IRS has already laid out in pretty decent detail what this process is. This is for taxpayers who meet the following requirements, that they've filed an ERC claim, but they haven't received their refund check yet, or if they have received a refund check, have not deposited or cashed that check. So you have to meet those two requirements, as well as you can file for this withdrawal process if the refund, the ERC, was claimed on a 941X. There were some instances in 2020 and 2021 where the refund claims could be filed with a current 940 or quarterly form, or 941 or the quarterly filing, but most of the claims that we saw were on an amended tax return. So it would be an amended tax return that would be withdrawn from the IRS for these ERCs. That the client wants to, or the taxpayer wants to, withdraw the entire amount of refund that was claimed. It's not a partial withdrawal. And then the final requirement here is that the IRS has not paid the claim, or like I said earlier, if it has been paid, that the taxpayer has not negotiated that payment. This isn't a get out of jail free card. This is still, if the IRS would happen to discover that a claim was erroneously filed with malintent, or if it was fraudulently filed, or there was an attempt to commit fraud, there could still be prosecution, you know, if that was discovered down the road. So The IRS, once they receive these withdrawal claims, will still investigate whether or not they think that the withdrawal is appropriate and that the refund or the claim was submitted fraudulently. There are going to be several different types of, or several different scenarios and a little bit of tweaks on the processes in the withdrawal process. So if a taxpayer has not received a refund and has not been notified that a claim is under audit, there'll be one like process A. If a taxpayer has not received a refund but has been notified that the claim is under audit, there'll be process B for withdrawing the claim. The third is that if a taxpayer has received a refund check but hasn't deposited yet, there'll be process C. So these are kind of expanded on a little more in depth on the IRS website for these different processes, but it just changes what has to be filed and who has to be notified in the withdrawal process. And as Mike was saying, with the ERC having been taxable income, some appropriately, hopefully, some taxpayers, if they have a receivable on their books for this ERC claim, they have already taken that revenue into their income. So if the withdrawal process is approved, which is kind of the final step in getting notification from the IRS, there's going to be a letter issued to taxpayers who are approved or denied this withdrawal. If a withdrawal is approved, then an amended income tax return may need to be filed in order to take that income back off the books or put back on wage expense, which was how taxpayers had to treat this ERC income. I wanted to mention briefly here, I'm not going to go through each one of these, but in mid-October, the House of Representatives Committee on Ways and Means issued a letter with 10 questions to the IRS in response to this moratorium, basically saying, we understand what your goal is here, but there are still valid claims out there that do need to be processed and need to be handled. So basically, what do you actually think the processing time is on these new claims? You've given yourselves to the end of the year. What is that actual time going to look like? How do you expect to eliminate the backlog, the 849,000 claims that still have to be processed? Are you going to put into place any fraud prevention measures that need to be codified, that need legislative support from Congress? Is there anything that you plan to do with that? And then finally, from a taxpayer-facing standpoint, will there be any status check or portal, kind of like a Where's My Refund tool on the individual side of things? Is that going to be anything that's available to taxpayers? And the requested response date was, I think, the end of October from the IRS. I don't think that there was any response issued, but there is some legislative interplay here with these credits and with the moratorium. Dawn mentioned earlier this morning that ERC can have a big impact on M&A transactions, and I just wanted to expand on that a little bit, particularly from a buyer side in a stock transaction. So we learned that, in an asset deal, there are very specific assets and very specific liabilities assumed by a buyer. In a stock transaction, the whole kit and caboodle is going to come over to the buyer. So if there are unreceived claims for ERC refunds, the buyer really needs to dig into that and understand, as part of the due diligence, where the claim is and at what point of the process that is. If it was a valid claim, is there any issue that perhaps the quality of work should come into question? Was the claim prepared by and submitted by a reputable CPA firm? Was it one of these ERC promoters? So they could be inheriting, the buyer could be inheriting some liability and some risk here with these unreceived, and potentially have to go back and recover some funds through this ERC process. Now, one of the commentary that I was listening to about this withdrawal process is whether or not a buyer could kind of step into the shoes of the applicant for these ERC claims and start the withdrawal process. And that's really kind of undetermined at this point. If during due diligence it's determined that an ERC claim was incorrectly filed, could the buyer then start the withdrawal process. And that's kind of unknown at this point. This is just briefly in your materials. You'll see we have some tools that the IRS has put out, some checklists, FAQs, a lot more detail on the specifics of the withdrawal process. So these links are live, and you could go read about it if this applies to you. So we'll transition now to the Federal Corporate Transparency Act. Mike will kick us off with this.
All right, perfect. So if you avoided that first whammy, nobody? I thought.
No whammy,
come on,
no whammy,
press your
no
luck,
whammy.
the whammy, avoid the whammy. All right, the Federal Corporate Transparency Act. Let me read you directly from the Department of Treasury's website with respect to what the purpose of it is. It's the purpose of combating criminal or other nefarious activities conducted through commercial enterprises, namely money laundering. And I have to tell you, I do a lot of reading, pay attention to a lot of things, well, I was a little bit in the dark relative to this until I had gone to Mark and I attended a conference over the summertime, and I'd gone to one of the tax sessions. One of the individuals was talking about this, and I was really scratching my head. I'm like, why have I not heard about this? Well, part of the reason, perhaps is, well, this was passed in some law back in like 2020. Of course, what was going on in that year? A lot of things, right? Trying to bring yourself up to speed with many different things. But, the question becomes, who's like responsible for complying with this? Is this an accounting function, a legal function, an internal function? And I think that's still yet to be determined. And once you hear about this, I think, you may have some thoughts on that, but everybody just needs to sort of be aware of this. And basically, what the Department of Treasury is requiring is if you meet certain parameters and specifications that you need to supply the Department of Treasury with basically all of the owners, or many of the owners, and key individuals that control the activity within that organization. We're coming up right now on basically the compliance season relative to this Transparency Act. But what's interesting about this, though, is you kind of have to think about, okay, when would you be filing this return? If you think about it, okay, think about the F-bar. When do you file the F-bar? Well, you sort of file it in conjunction with doing your tax return. And I think a lot of people think that you would file this Transparency Act form in conjunction with or at the time of preparing the tax return. But the way that the rules are kind of laid out here, when you submit that form to the Treasury, there's a question about, is it supposed to be current as of the day of the submission, or is it current as of like the last day of the year? And I think that's to be determined. But if you note this third bullet point where the Treasury suggests that if there's a change to what's supposed to be on that form, you have to notify them within 30 days. I think that leads me to believe that it's supposed to be current as of the time of submission. So, what's on the tax return may not, in fact, actually be what should go on this form relative to the individuals that are supposed to be on there. So that's, we're kind of, right now we're still sort of noodling through this to try to figure out exactly how this is going to work. Now, I think Rebecca's talked to other law firms, I've talked to law firms too, and they're basically using this as an opportunity to re-engage with all of the businesses that they've helped form and service over the years, and I suspect we'll do the same thing, making people aware, but not really sure if it's a accounting submission, a legal submission, or an internal submission. I think that's one of the items that everybody's got to kind of think through, but at least you're a little bit knowledgeable in this, knowing that this is coming down the pipe.
So the burning question will be, or probably is at this point, what does this matter to me and to my company? Am I subject to this filing requirement, this beneficial owner information report? And then so that to answer that, we look at the definition of what is a reporting company. The FinCEN has issued quite a bit of guidance on these rules and these regulations for reporting. A reporting company is, well, most entities. A corporation, LLCs, limited partnerships, limited liability partnerships, associations, business trusts. Essentially, any entity that is formed within the laws of a state in the United States is subject to potentially subject to these reporting requirements, as well as foreign entities, so non-US companies that have registered to do business within the United States. Graciously, the FinCEN has provided 23 specific exemptions. So if a company falls underneath one of these 23 exemptions, there is no reporting requirement and they are not considered to be a reporting company. I didn't list all 23 here. Some of them are very specific, but I think maybe the most common will be governmental authorities, banks, investment advisor companies, venture capital fund advisors, insurance companies, accounting firms, interestingly, are excluded, public utilities, tax-exempt entities, which is kind of a critical piece here. Tax-exempt entities are not subject to this reporting, and large operating companies. I think that the most reprieve that many US companies will feel is in this large operating company definition. It's smaller than you might think. So a large operating company meets all 6 of the following. If it employs more than 20 full-time employees, more than 20 full-time employees are employed in the United States, there's an operating presence within the United States, physical location in the US. The operating entity filed a tax return in the previous year that reported more than $5 million in gross revenue, which would be net of returns. And those were properly reported on the common tax filing form 1120, 1065, 1120S, et cetera. And those $5 million, that threshold, those sales were US sales, were not foreign sales. So there can be foreign sales of a company, of course, but 5 million of that has to be in the US. So this will, though, require small to medium-sized companies to comply with these requests, which is, another added burden and another layer of reporting.
Yeah, relative to who's a beneficial owner, that's important because those are the individuals that are going to have their information submitted to the Treasury Department, and those are individuals that own at least 25%, either indirectly or directly, of the underlying entity. But it also includes those individuals that exercise substantial control, right? And that's kind of interesting because, of course, those people are not owners. So who are those people? Well, they're senior officers. They're those individuals that have the authority to appoint or remove any senior officer. They're important decision makers relative to the company's business or financials or structures, and any other person with substantial control. And this is where I think the question comes in as to who's making this determination as to who these individuals are. And again, I think it's one of those things you provide the guidance and have the conversation, but obviously the company is ultimately responsible for everything. But ultimately, would you be relying on some combination of your accounting and legal team to kind of make yourself aware of this and make this assessment? I think it's critically important because there is no limit on how many people can be included as part of this submission. So, I mean, hypothetically, it would seem kind of crazy relative to that large company exemption, but, theoretically, you could have 20, 30 people in there that, have to submit their information to the Treasury. So, kind of something to, again, keep your eye on and kind of understand, hey, if you're one of these people, might be a little eye-opening to you. And of course, we just have a slide on here, determining your ownership interest. These are the attributes you'd have to look at. So it's not just your equity, stock, or voting rights. It's these other items in order to assess whether you've got that 25% mark.
Sorry, I think we keep hitting at the same time. We can go back one. So there are exceptions to who is considered a beneficial owner. A minor child is not, so this first one, a minor child, is not required to report their own information. So when we're talking about these beneficial owners, who's a beneficial owner, there are specific exemptions. An ownership interest that is held by a minor child, which would be, if a minor child owns 25% or more of a reporting company, their ownership piece still needs to be reported, but it is not the minor's information. It would be a parent or legal guardian, which would need to report their own information in lieu of the child's. That exception would cease to apply once the child has reached the age of majority. A nominee, an intermediary, sorry guys, there we go. A nominee, an intermediary, a custodian, or an agent is also not considered to be a beneficial owner, so would not need to report and be included in this filing. Any employee who is a general employee and not a senior officer or who exerts no substantial control over the organization would not need to have any information reported, as well as an inheritor. So that would be somebody, of course, named in a trust document, a will document, as long as that's a future interest and there has been no triggering event. And then a creditor whose only right would be to receive payments in the future would be not considered a beneficial owner, but only if the relationship stops there. There can't be any ownership rising to the level of a reporting requirement for a creditor to be excluded. In addition to reporting company beneficial owner information, there is also company applicant reporting disclosure required also. There could be 1 or 2 company applicants on this form, just depending on who was actually responsible for filing the legal documents to form the entity. So, this could be an attorney, would be a direct company applicant, or somebody at the attorney's office who physically or electronically submitted the registration documents with a state. There could also be a secondary company applicant reported, which would be somebody maybe within the organization who is responsible for or controlled the filing of those organizational documents. So at least 1, but possibly 2 company applicants will be required to be reported on this BOI form. There is a little bit of reprieve here because if an entity existed prior to January 4th, 2024, no company applicant information is required to be reported. If a company is formed after January 1st, there is required disclosure for these company applicants in addition to beneficial owners. The information on the company side is pretty benign. It's just legal name or DBA, the jurisdiction in which the entity was formed, U.S. address, the current U.S. address, and then the TIN, which presumably would be an employer identification number. So very standard information for the reporting company. Where things get just a little sticky is in the beneficial owner reporting and what details must be disclosed.
Yeah, relative to the beneficial owners, some basic information that you might think, obviously your name, date of birth, your address. But then this other item down here at the end, identifying number, issuing jurisdiction, and image, one of the following. Check this out: U.S. passport, your driver's license, other state ID, or your foreign passport. There's some other items in here we didn't put on the slide. You have to let them know if you have any pets, what their names are, where you shop at, and also how far you can hit your 7-iron. Those things are also critically important for this. And if you're concerned about giving all this information to somebody to submit this as part of your documentation, the application that has to go in there, you yourself can actually submit all this information to FinCEN, and they'll give you a unique number. And then you can provide that number to the reporting entity, and that takes the place of all of this information. So I assume this is kind of going to sort of be like your social security number. You have it one pocket, this one in the other one. You don't want to let anybody know either one of those numbers. So if you find yourself in a situation where you think you're going to have to be providing this, several times, it might behoove you to just go out to FinCEN and get that unique number so you can just provide that in the end. All right, right now, as far as we know, the only way to submit this is electronically. But no further information is available on that. The system's not up and running, so we don't know exactly how that's going to work, but apparently it's going to be electronic. They say there's not going to be a filing fee relative to this, and of course they caution everybody that there's probably going to be some fraud relative to this, people asking for your information and saying, well, it's because of this, so you need to really give it to us, and of course, you may not have to. So just watch, relative to that. And in our slide deck and information, there's some more resources out there with some links that you can go to find more and read more about this.
So I feel like this is maybe another whammy here. In Pennsylvania, also jumping on reporting bandwagon, they have passed Pennsylvania passed legislation called Act 122, which was passed in 2022, that requires companies to move into a structure where annual reporting is required. Previously, up until this point, the report was required to be filed every 10 years. So it's kind of, something you did every 10 years and completely off a company's radar until the next 10 years rolled around. Pennsylvania has decided that in order to stay current with the Department of State listing of which entities are permitted to transact business and registered to do business with the state, that this annual reporting needs to be completed and companies need to be in compliance. So it is effective, again, this magical date, January 1st of 2024. The first filing will not be due until 2025, and that is for any entity that is in existence as of December 31st, 2024. There are some staggered reporting dates depending on the type of entity that is involved. June 30th is relative to corporations, so this is for-profit and non-profit. September 30th for LLCs, and then December 31st, 2025 for all other entities. And again, these are annual dates. Now, unlike the Federal Corporate Transparency Act, Pennsylvania basically says if you are a business that is registered or formed within the laws of the Commonwealth or registered to do business in the Commonwealth, you must file. So this includes corporations. It does include nonprofits, tax-exempt entities, and all other entities, LLPs, limited partnerships, LLCs, business trusts, and associations. And then as well, it includes foreign entities, so not outside the U.S., but outside of Pennsylvania. If an entity is registered or formed within the laws of another state, but is registered to do business in Pennsylvania, they're included in this annual filing as well.
All right, and what are you reporting on here? There's some basic information, much less cumbersome relative to the FinCEN reporting, but of course, your business name, the jurisdiction of formation, which may not be Pennsylvania, your registered office, the name of at least one, key person, whether that be a director, member, partner, et cetera, the names and titles of the principal officers, the address, and the entity number, which has been issued by the Department of State. How do you file this thing? Well, right now, electronic or hard copy is going to cost you $7, so add that into your budget for the year. And it's going to be pretty critical to have your information correct, and here's why. If you don't have it correct, and the Pennsylvania has an issue with this, you have a certain period of time to cure this, and if you don't cure this, administratively, Pennsylvania is going to dissolve your entity. And when you go to reapply and resubmit this information, it's possible that the name that you're looking for may not be available at that time. So you really don't want to find yourself in this jackpot of having to go through this process. So you have a long runway, right? Even though you have to start filing this pretty soon, you have a long runway until 2027 before this really becomes an issue. So get some practice in now, get those forms in, make sure you know what you're doing.
Okay, I feel like we can just breathe a little bit of sigh here and just move into a little bit of informational updates, not any new reporting requirements for the rest of the time that we'll talk. We did want to touch base on specified research and experimental expenditures, SREs, or R&D costs. I think most of us are familiar with the changes that came through Tax Cuts and Jobs Act relative to R&D expenses. Prior to Tax Cuts and Jobs Act, businesses could expense R&D costs currently, current deduction, current tax deduction. There were some circumstances in which a business may choose to capitalize those costs and amortize over 60 months or 120 months, or even capitalize those into a capital account with no amortization. We saw that a lot less in practice. Most entities that were engaging in R&D costs wanted that current deduction and could utilize the current deduction. With the passage of the Tax Cuts and Jobs Act at the end of 2017, there was a major shift, a major change that came about through Code Section 174. These expenses were redefined a bit to be renamed specified research and experimentation or experimental expenditures. And the current deduction has been removed. There's no longer an option to deduct R&D costs currently. They must be amortized, capitalized and amortized over 5 years for domestic expenses, or 15 years for foreign expenses. And these are half-year conventions, so really you're talking about spanning more than the 5 and the 15 years. It covers more, a 6 and a 16-year tax period. These went into effect, this treatment went into effect with tax year 2022. So what we saw is, Mike may touch on this, but there were even some extensions on tax returns that may have been filed in the spring of 2023 because these kicked into place in 2022, trying to figure out if there would be any relief or reprieve issued later on in 2023 so that companies wouldn't have to treat their R&D costs this way. But that did not happen. Mike will get into that a little bit. So what we saw is that many companies had to capitalize sometimes very substantial amounts of SREs into their balance sheet for tax purposes and deduct them ratably over a 60-month period. The definition of SREs does now include in-house software development costs, which can be impactful, of course, to companies who are developing those. And then one of the other important factors here is that this change is considered to be a technical change in accounting method. Many changes in accounting method are required to be disclosed or requested by filing a Form 3115. Thankfully, the IRS issued at the beginning of 2023 a discussion that allowed taxpayers to file a current statement with their tax return so that there was a little bit of relief from the 3115 form itself.
Yeah, and like it's been mentioned already before, there was an unbelievable amount of support from the tax community to really get this repealed and retroactive to 1/1/2022. Of course, that didn't happen. We did have, at least in my view, an inordinate amount of returns that were extended this year because of this issue. And as we stand here today in 2023, we still have the same issue that's out there. And from what we know, there is tremendous support to really repeal that and change it so that we aren't having the situation where businesses are having to capitalize these expenses. In almost every circumstance, in fact, I think it is every circumstance, you're really upside down relative to what's happening here. If you think about it, what you capitalize and amortize in that 1 year relative to what your credit is, you actually end up with more tax. In fact, we've had some, in at least one situation, one business that we service, really, shocked by that and having a tough time really, working their way through that. And I don't disagree with them. If you think about it, if you're looking to, raise revenue from a governmental standpoint, why would you choose the R&D credit for that? It seems to run counter to what it's all about. A couple weeks ago, I had met with a specialty research and development tax credit firm, and they were telling us that they had actually gone out to a certain number of congressional representatives, people actually serving in Congress, and try to explain this issue to them. Say, do you understand what you voted for relative to this? And they said that many of them did, have a recollection of what it is, but they didn't understand what the practical components of it were. So they did provide those examples, and in every circumstance, those individuals were really shocked by the ramification of this change. So it's hard to say what's going to happen, but I believe there's support by almost everybody to get this changed. It's just a matter of when will that happen. Okay, we've got 3 minutes left. So we've got two or three items. I'll spin through this quick. This pass-through entity tax. Right, what's this all about? Well, one of the common questions I get with respect to individuals is, hey, how come I don't itemize anymore? Well, the reason you don't itemize is, I mean, simplistically, you don't have enough deductions that exceed the standard deduction. But one of the reasons for that is because there's a limitation on how much state, local, and real estate taxes you can deduct as part of that Schedule A. Right now, it's capped at $10,000. And if you're a higher earner, you're paying a lot of those types of taxes. That's what's causing you to itemize. So anything that you're paying above that 10 grand, you're not realizing any tax benefit from that. So states really got smart about this, and they said, well, relative to that particular kind of tax, we'll allow the business to pay the tax on behalf of the owners and partners and such, and they can deduct that as part of the corporate tax return, and that's how the individuals will realize that benefit. And the IRS is, believe it or not, on board with this. They've actually issued some notices relative to this. Unfortunately, who's not on board with this as of now, this nice map here, are the yellow states. And of course, we're situated in a yellow state. So right now, we don't have that opportunity. And there is legislation that's out there relative to this, but we'll have to kind of see where that goes. And for anybody that's counting, if you look at those numbers, 36, 3, and 9, that's 51. That's because Washington, D.C. is in there. So don't ask us afterwards why there's 51 instead of 50. Get back to you.
All right, and in 1 minute, I'm going to touch on my potpourri here. So in corporations in Pennsylvania who are operating as C corporations are going to enjoy a phase down in the corporate net income tax rate. Between 2023, that rate goes from 9.99% to 8.99%, phases down 0.5% through tax year 2031. It hits 4.99%. So, thankfully that brings some parity between the C corporations operating in Pennsylvania and pass-through entities, which get taxed at the individual rate of 3.07%. Our neighbor Ohio has brought some changes to the commercial activity tax. It has raised the exemption from $1 million of gross revenue in Ohio over the next 2 years, going up to $3 million in 2024, $6 million in 2025, and has also eliminated calendar year filing. So Ohio is going to a quarterly filing for the commercial activity tax, as well as eliminating the $150 minimum tax. And then another phase down to mention here is bonus depreciation. We've enjoyed 100% bonus depreciation over the last few years. Absent any legislative changes over the next few years, which we would be hopeful for, but right now, as the law stands, bonus depreciation is phasing down 20% over the next 4 years. And then my only little individual note here is that the Secure Act 2.0 increased the RMD age again from 72 to 73 for anybody who has not yet attained 72 by the end of 2022. So with that, we thank you for your attention. We don't want to stand in between anybody and their cookies.
Yeah. So